Hi there, I'm Jon McInnes from Harvest Accounting Group. Whether you're buying your first property or are upgrading your family home or perhaps are already an experienced property investor, when it comes to securing your financial future, creating wealth through property is a very hot topic for many people. And today, we're very excited to be joined by one of Sydney's leading property experts, Anna Porter from Suburbanite. Anna, thanks for joining us today. Firstly, you've lived and breathed property now for how many years?
I've been in the property industry for over a decade. I started my career off in the valuation profession. I'm still a registered certified practicing valuer. When I was valuing, we saw a lot of buyers not getting advice at all. A lot of investors getting really bad advice, if any. Very common scenario of an investor buying a house around the corner from them because that's in their comfort zone. When I was valuing, I decided that there was a real gap in the market there. Decided that there probably needed to be something exclusively for buyers and investors, and that valuation background really underpins that property knowledge to help investors make great decisions. So a number of years back I started Suburbanite, and the focus is helping buyers and investors make great investment decisions, and it's really taken off since then.
Right, so first key question to you, Anna. It's now June 2014, and the term property bubble is something that perhaps concerns many investors. We've seen Sydney experience some impressive growth over the last 12 months. Interest rates are at historical lows. Properties are selling inside a week.
Yeah.
Is the Sydney market now too hot?
Really great question, John. I get asked this property bubble question all the time. There are some pockets that are a little bit overheated. There are some individual buyers out there paying too much for properties in often one-off circumstances, not across the board. Are we in a property bubble? We really aren't. We're at the early stages of a cyclical upswing. So we had about 15% growth, give or take. I think the statistic sits at 15.1% across Sydney on average for the year 2013. So what does that mean in context? In context, we had our last peak in Sydney in 2003. And then after that, property values should around about double every 10 years if we follow a traditional market cycle. So after 2003, we had that wonderful little GFC. Wasn't that fun? And the values really didn't do anything for a long time. Values stayed really soft for 8 years plus. So we've had about 15% growth in a 12-month period, but that's the only significant growth we've had since about 2004. So that would indicate if we've got to have a doubling in value, yes, this cycle's been prolonged, but we're really only a little bit of the way in, and there should still be a lot of growth to be had. Having said that though, we do expect values to level out a bit. We expect to see a plateau in the market coming up in the latter part of 2014. What'll happen is there'll be more stock coming onto the market, and that'll soften that buyer activity. So by no means are we thinking values are going backwards, aside from the odd mistake that one investor's made and paid too much, or some little pockets that I said were overheated. Generally the market will level off, but we don't see prices coming backwards by any means. Then in a few years' time, we'll see that growth come through again.
Okay, so do you think there is still an opportunity to get some good deals in metropolitan Sydney?
There certainly is. There's some really good infrastructure projects rolling out and new development rolling out across Sydney, which really does create good opportunities for investors. There are still some areas that are really coming into their own throughout Sydney metropolitan. It just may not mean that you're in the CBD because that price point's getting higher and higher and pricing out some investors. But going out from there, there are good opportunities. Investors just need to remember though, not all development is good development. So I'm very pro-development in a lot of ways, but if you're buying an investment property in an area and you're buying a unit and there are a lot of units popping up all over the place, you'll be in competition with that, and that will soften not only potentially the growth, but most certainly the rental demand, because tenants just have so much more to pick from. So research the development in the area and make sure it's the right fit for what you're trying to achieve, and it's not going to have the opposite effect and soften some of the market that you're trying to tap into.
So talking of rental returns, for those investors that have got existing property in Sydney, what would you consider to be a solid rental yield for your standard 2-bedroom apartment in metropolitan Sydney?
That's a really good question. It's not what it was 12 months ago, because what has happened in the Sydney market is we've had this growth in value come through, and rents just can't keep up at the same pace. So when it used to be you'd buy a property for say $500,000 and you'd get your $500 a week rental return, that was a good yield. But now that's really weakened because the rents haven't kept up with that buy-in price. And the other thing that's happened is a lot of investors have entered the market in more pockets than others. There's some pockets that especially have drawn investors in. And now they're starting to put all these properties back onto the market for rent, and that further softens rent. So what we're seeing in Sydney is, depending on exactly where you are, a 2-bedroom unit, say, you could be looking at about 3 to 4, even 4.5% rental yield, which is okay. Moving out of Sydney Central and getting into more metropolitan areas and even further out, we're seeing probably more in that 4 to even still getting into that slightly up towards that 5% return mark. So it depends what property you're looking at and where you are, but the yields can sit, it's pretty vast, anywhere between 3 and 4.5%.
And when we talk of rental yield, we're referring to the gross rent per annum, so what the tenant is paying for that property per annum, compared to the value of the property itself?
That's exactly what we mean. It is the rental income compared to the value or the purchase price. Some investment firms, though, look at it a little differently, and they take into account the investor's borrowing capacity when they make that assessment. So if you're buying a $500,000 property and you've got a $50,000 or even a $100,000 deposit, they'll just look at the money you've borrowed and the rental return, which really isn't an accurate assessment. That doesn't compare property to property, that compares investor to investor. So the way I look at it is anyone can have a positively geared property if they've got a big enough deposit. That's all that's really assessing. That's a cash flow analysis, which is really important for every investor to do, but it's not an accurate gauge of comparing yield from one property to the next property, because every investor is going to have a different deposit amount and different borrowing amount. We also need to be aware when we're looking, you mentioned the gross rental return. That's generally our starting point, but then we do have to look at the costs associated with that property. So if the strata fees are unusually high on a unit, that's going to obviously affect the bottom line. So we do need to take it that step further and look at the layers of how that investment will perform for the investor.
Okay, so if we take an example of a true rental yield, if an investor's purchased a property for, say, $500,000 and is receiving rent of $500 per week, that would equate to $26,000 per year rental received, which is a little bit over 5% rental yield, which, based on your previous comments, would be pretty good going in today's market.
That's correct.
So in terms of the Australian market as a whole, where do you see some other states sit in their respective cycles?
That's a fantastic question, because investors do need to look at all the different markets and decide what's best for them when they're investing. As we talked about before, there's this market cycle where values should traditionally roughly double over about a 10-year cycle, excluding the last 10 years because of that GFC we talked about. So where is everywhere else sitting? At the moment, Perth and Darwin are sitting right up the top and they're about to hit their peak. What happens once you get to a peak, the market goes from here to here. There is a slight correction where it does come back down a bit because it gets a little overheated at the top. So they would be expected to go through a bit of a correction maybe in the next year or two, where values will actually decline. And that's what we're seeing happen in Canberra and the ACT at the moment. When you look at the growth statistics, there's a negative in front of the numbers because the values are actively declining. They're just starting to level off a bit now. In terms of Melbourne and Brisbane, they sit at the bottom of the cycle where they're positioned for growth, but generally to be a lot slower and a lot softer. So we've just seen a little bit of growth there in the last 12 months. It's not as strong compared to Sydney. So they went through their recovery, their low part of the cycle, and now we're just seeing a little bit of growth. What are some of the risks in that part of the cycle? We often see there's high vacancy and the rental market isn't as strong because they've come through a period of really strong growth where there's been oversupply of new developments. And then part of what's stopped that growth and hit that peak is the oversupply issue. So it takes a while for that market to absorb it. So there is more property for tenants to pick from than what there is demand. Whereas Sydney doesn't have that oversupply and the rental market issue as much at the moment, and it's moving further into that growth cycle and into a more strong growth cycle.